Corey Thompson here with Roughneck Real Estate, here to show you again how to get into real estate investing, how I went from a laid off drilling consultant to a real estate investor. Not really overnight, it's been 7 years, but it does feel like it's been such a short period of time. Guys, investors everywhere, whenever I first got in this business, told me about the 70% rule, and I had no idea what they were talking about. Essentially, they go off of ARV, which stands for after repaired value. Most investors want to buy at 70% of ARV, okay? I didn't understand this. I didn't know why that was such a big number. To me, a 30% margin seemed huge. But once I got into a few deals, I realized on top of every single deal you sell, if you buy a property and then you sell it on the retail market, you're immediately going to have 10% closing cost. That's real estate, title fees, all of that. So you're really only getting a 20% margin if everything goes perfect. But how easy is it to go over 10% on a repair budget? Seems pretty simple, right? If you have a $100,000 property, if you got to buy it at the 70% rule, that means you got to buy it at $70,000. Okay, all in. This includes repairs, which means you might only be buying it for $50,000 and then have $20,000 in repairs, equals $70K. Okay, if that's the case, and you run over $5,000 of overage on your repairs, that's a full 5% pay cut, okay? On top of this, in the last 2 years, we've seen record appreciation. If you do this perfectly, if you buy and you're able to rehab it and you come in under 70%, I think something in the last 2 years, you've seen like 20% appreciation, okay? So even if the market resets back to 2019 levels, okay, it'll only erase 20%. So you'll still have a little bit of equity, but I wouldn't depend on that too much. To be quite honest with you guys, I like the 70% rule. It's a good base rule, but in our current economy, you really need to switch that down to the 60% rule or the 50% rule, because as interest rates go up, equity is going to disappear off of your property simply because you're going to have less buyers in the marketplace. This might have an inverse effect. I don't know where the cutoff is as far as, if you got a $500,000 property, it's probably going to be affected fairly quickly. Where if you have a $200,000 property, maybe it gets more pressure put on it from the buyers that can no longer afford the $500,000 house. So now they can only afford the $200,000 house. So maybe there's more buyers in that $200,000 price range than there were before. I don't know. That's all just speculation. But if you're out in the marketplace trying to buy right now and you're using the 70% rule, it might be a good idea to bump that down to the 60% rule or even the 50% rule if you're still in the marketplace. If you go to our previous videos or follow the link above, wherever it is, I'll explain the 2% rent rule on rentals. And if you're buying using that rule, equity will never be your issue. You'll always have equity on the property. Again, that's just my opinion. I'm not a licensed real estate agent. I don't know what the real estate crystal ball holds, but in this marketplace, you need to know both the 70% rule and the 2% rule if you're going to continue buying.